This is the story of how Canada's largest fintech challenger, Wealthsimple, fundamentally altered its business model to survive a new era of high interest rates and shifting market expectations. In the spring of 2021, the company was the undisputed darling of the venture capital world, reaching a valuation of $5 billion, following a massive $750 million funding round led by Greylock and Meritech. At the time, its strategy was built on the momentum of the pandemic-era retail trading boom, a period defined by excess liquidity and a sudden surge in retail participation in the financial markets. This growth was fueled by an aggressive expansion into high-risk, high-reward sectors, including cryptocurrency trading, venture capital funds for retail investors, and zero-commission stock trading. However, as the global economy shifted in 2022, the era of cheap money came to an abrupt and painful end. Inflation surged to levels not seen in decades, central banks worldwide began a rapid tightening cycle, and the speculative fervor that had powered fintech growth began to evaporate almost overnight. By June 2022, Wealthsimple was forced to confront a new reality, announcing a layoff of 159 employees, which represented roughly 13% of its total workforce. CEO Michael Katchen characterized this moment as a necessary response to a volatile market, but in reality it was much more than a simple corporate downsizing. It marked the end of the growth at all costs era and the beginning of a calculated high-stakes move toward becoming a full-service primary bank for the modern Canadian consumer. Wealthsimple's decision to prioritize sustainable revenue over sheer user acquisition numbers reflects a broader cooling of the global venture capital market, where investors began demanding a clear path to profitability rather than just top-line growth. The company realized that relying on the volatile commissions of retail stock and crypto traders was no longer a viable path to long-term stability in an environment where capital was no longer free. To understand the scale of this pivot, one must look at the hidden mechanics of how Wealthsimple reorganized its entire product suite to capture the primary banking relationship of its most valuable users. Historically, the company functioned as a secondary tool, a place where young investors might put a few $100s to experiment with stocks or ETFs. To survive the downturn, Wealthsimple needed to move from the periphery of a client's financial life to the center. They began an aggressive pivot into boring but highly profitable banking services, leveraging the Bank of Canada's interest rate hikes to generate significant net interest margin. While traditional Big Five banks were slow to pass higher interest rates onto their savers, Wealthsimple acted with digital speed, offering industry-leading rates on its Wealthsimple cash accounts. This maneuver allowed them to lure in billions of dollars in new deposits, turning the company into a formidable competitor for household savings. The strategic shift was underpinned by a cold, analytical assessment of user lifetime value. The company transitioned from a heavy marketing focus on free trading to a focus on core deposits. By 2024, this strategy had yielded significant results, as the company officially reached $30 billion in assets under administration. This growth was not driven by speculative day trading, but by users moving their entire paychecks and emergency funds into the Wealthsimple ecosystem. The introduction of private credit and private equity products, through partnerships with institutional firms like Sagard, allowed Wealthsimple to offer high-yield, institutional-grade investments to retail clients who were previously locked out of these asset classes. This effectively replicated the sophisticated wealth management services of a private bank, but at a fraction of the cost and with a significantly better user interface. This technological advantage allowed the company to maintain higher margins while offering more competitive rates than legacy institutions that were still burdened by the overhead of thousands of physical branches. This evolution reached a critical milestone in early 2024 when the company announced it had achieved profitability on an adjusted EBITDA basis. This was a feat many skeptics believed was impossible for a digital platform that built its reputation on low fees and free services. The profitability was driven by a more diversified revenue stream that included managed investing fees, interest on cash deposits, and the expansion of its lending business. By late 2024 and heading into 2025, the company's assets under administration surged past the $50 billion mark, reaching their long-term growth target significantly ahead of schedule. The company's trajectory mirrors a global reassessment of the fintech industry, where companies like Robinhood in the United States and Revolut in Europe have faced similar pressures to prove they can make money without relying on constant venture capital infusions. In the United States, the sudden rise in the cost of capital ended a decade of subsidized services, forcing a survival of the fittest scenario across the entire tech sector. Wealthsimple's pivot is particularly notable because it occurred within the highly protected and concentrated Canadian banking system, which is dominated by a few massive, centuries-old institutions. While many international challengers failed to penetrate their local markets due to high customer acquisition costs and regulatory hurdles, Wealthsimple's decision to embrace traditional banking products helped it gain a level of legitimacy that few other fintechs have achieved. They stopped trying to kill the banks and instead focused on becoming a better version of one. This trend indicates that the disruptor phase of the last decade has been replaced by a convergence phase, where digital and traditional finance look increasingly similar in their product offerings, if not in their delivery. Markets are no longer rewarding sheer user growth or viral features. They are rewarding companies that can demonstrate a clear, compounding path to quarterly profit and long-term solvency. The real-world impact of this decision is visible in the changing relationship between Canadians and their financial institutions. By moving away from niche investment products toward a unified, automated banking app, Wealthsimple has pressured the major banks to accelerate their own digital transformations. For the average consumer, this pivot means that digital-first platforms are no longer just for fun money or experimental trading. They have become viable, safe repositories for life savings and home loans. This shift changes the risk profile for the entire financial sector. As of late 2025, Wealthsimple serves over 3 million Canadians, representing a significant portion of the country's workforce and a massive share of the millennial and Gen Z demographic. The company's ability to remain solvent and grow during a period of intense economic volatility has solidified the role of fintech in a stable economy. Furthermore, the pivot involved a sophisticated use of data to cross-sell products. Wealthsimple's algorithms could identify when a user had enough cash in their savings account to benefit from a tax-advantaged investment account, or when their spending patterns suggested they were ready for a mortgage. This proactive banking model is a sharp departure from the reactive model of traditional banks, where a client often has to visit a branch or initiate a call to receive advice. By automating the movement of money between accounts to maximize interest and minimize taxes, Wealthsimple created a sticky ecosystem that is difficult for users to leave. This automation is the key to their economic model. It allows them to manage billions of dollars with a fraction of the headcount required by a traditional bank. The 2022 layoffs, while painful, allowed the company to lean out and focus its engineering resources on these high-value, automated banking features rather than speculative experimental products. The shift also saw Wealthsimple lean into its generation and premium tiers, which offer lower fees and higher interest rates to clients with larger balances. This was a direct move to court older, wealthier Canadians who had previously been hesitant to trust a digital-only firm. By late 2025, the average account size on the platform had grown significantly, proving that the company had successfully moved up market. This was critical for profitability, as the cost to serve a client with $100,000 is roughly the same as the cost to serve a client with $1,000, but the revenue generated is vastly different. The decision to rework the growth model was therefore a move toward high-value, long-term relationships rather than high-volume, low-value transactions. This mirrors the evolution of other successful tech companies that began by serving the unbanked or the underserved, but eventually matured to capture the most profitable segments of the market. Ultimately, Wealthsimple's story is a testament to the fact that in the world of finance, speed is a temporary advantage, but stability and trust are the ultimate currencies. The decision to rework its growth model was not just a reaction to a bad quarter or a shift in the stock market. It was a necessary evolution to ensure the company's survival in a post-zero interest rate world. This transition from a trendy, brightly colored app into a foundational financial institution marks a quiet but permanent change in the Canadian economy. The days of fintechs operating like social media companies, obsessing over daily active users and engagement, are over. The new era is defined by fiscal discipline, net interest margins, and the pursuit of the total wallet share. Wealthsimple's pivot signals that the next generation of finance will be defined by those who can balance the speed of software with the cold, hard discipline of a profitable balance sheet. This is the new blueprint for fintech survival. Move fast, but make sure the math works.